Welcome to another episode of Delta Investments Deep Dive, where we go in depth and unpack our research on specific stocks and discuss the risks. We are recording this episode on Sunday, March 8, 2026. In this episode, we are going to focus a bit on the geopolitical tensions. Don't worry, we're not here to discuss war. But as investors, sometimes it is important to analyze certain industries that are affected by these tensions and to see what company is showing promise. In a few minutes, we will get into our company for today. Embraer, the Brazilian aircraft manufacturer that you probably never heard of. However, before this, let us talk about the industry for a moment.
Yeah, and to really understand why we are looking at this specific company today, you have to zoom out first. You have to look at the broader macro aerospace environment over these last 6 months.
Right, exactly. And just to set the stage for you listening, our mission today is really unpacking this massive shift in global trade and how it is rewriting the rules for plane makers. We have been pulling from recent Q4 earnings reports from early 2026, some deep market analyses and recent defense contracts to really build out this picture for you.
Because the geopolitical friction we have been seeing, it's no longer just some abstract risk factor buried in the back of an annual report. It has crystallized into the primary driver of decision-making for every major aviation manufacturer.
I mean, we are seeing a really sharp resurgence in protectionist trade policies, right?
Exactly. The trade frictions, particularly between the U.S. and China, have introduced just massive financial collateral damage. And the legacy manufacturers, the big legacy guys, are absolutely bearing the brunt of this.
Right, so looking at the historical duopoly, you have Boeing and Airbus, and they are just encountering incredibly dense headwinds. Yeah. Boeing appears especially vulnerable right now.
Extremely vulnerable. They are dealing with Chinese retaliatory tariffs that actually reach up to 125%.
125%. That is just, I mean, you cannot just absorb that.
No, you can't. When you are dealing with a penalty of that magnitude, It is not a margin squeeze anymore. Those tariffs are actively blocking several of their physical deliveries. It is forcing Boeing to basically repatriate completed aircraft.
Which means you have an enormous amount of capital just sitting there.
Right.
Like tied up in physical inventory that cannot be handed over to the buyer.
Exactly. The capital expenditure to build a commercial airliner is staggering. So having completed planes sitting idle on a tarmac due to diplomatic standoffs, it creates a severe liquidity drain. And the instability isn't isolated to Boeing or the U.S. side either.
Right, because Airbus is feeling the heat too. Their CEO, Guillaume Ferry, recently issued a pretty stark warning.
He did. He stated that 2026 has begun with an unprecedented number of crises. He pointed directly to ongoing trade disputes and the threat of U.S. tariffs against traditional allies like Canada and Europe,
which threatens those highly integrated supply chains they rely on.
Exactly. These aren't just isolated trade spats. They threaten to completely fracture the globally integrated supply chains that these massive conglomerates have literally spent decades building up.
And that idea of a fractured supply chain is so central to what we are discussing today. Because for as long as any of us can remember, the aerospace sector operated on this strict philosophy of just-in-time manufacturing.
Right. The ultimate pursuit of cost efficiency.
You keep your warehouse inventory practically at zero. You engineer your logistics so that a specific localized part, like a titanium fastener or a specialized sensor, arrives on the assembly floor the exact morning it needs to be installed.
Which is brilliant, right? It's a brilliant model when global trade is frictionless and perfectly predictable.
But it's not predictable anymore.
Not at all. Under constant structural stress, that model just disintegrates. You factor in ongoing conflicts like the Russia-Ukraine war, which historically disrupted the flow of critical aerospace titanium, or the escalating hostilities in the Middle East that impact shipping routes and energy prices.
Which forces costly flight reroutes for the airlines, too.
Yeah, the operational burden on the airlines buying these planes goes way up. So the foundational assumptions of just-in-time manufacturing are just totally invalidated now. Manufacturers are being forced at great expense to pivot toward a resilience-first model.
So if you are an aerospace executive and you are staring at these disruptions, how do you actually implement a resilience-first model? Like, what does that practically look like for them?
It requires a fundamental rewiring of procurement. Companies are actively engaging in this practice known as friendshoring.
Friendshoring.
Yeah, instead of simply sourcing the absolute cheapest components from anywhere in the world, they are deliberately diversifying their suppliers to politically aligned nations, stable nations.
To minimize the risk of a sudden embargo
Yeah.
or a 125% tariff?
Exactly. And furthermore, they are strategically stockpiling critical components. They are choosing to absorb the higher carrying costs of warehousing massive inventories of parts simply to ensure the assembly line doesn't halt.
So the fragility at the top of the market is immense right now. Turning a massive entrenched supply chain ship like Boeing or Airbus, it takes years.
Decades even. And that extreme fragility at the top creates a structural paradigm shift. It opens this really rare window for an agile regional specialist to decouple from the broader market volatility. They can operate with a distinct competitive advantage right now.
Which brings our focus squarely onto our company for this deep dive, Embraer. Now, intuition might suggest to you that a Brazilian manufacturer would struggle immensely in this kind of protectionist environment.
And they certainly had to navigate some severe obstacles. I mean, let's be clear.
Right, throughout 2025, Embraer had to operate in a highly volatile trade landscape. Specifically, they were hit by a 10% U.S. import tariff. This was implemented under Section 122 of the Trade Act of 1974.
Right, those were measures carried over from the Trump administration.
Exactly. And just to put a hard number on that for you listening, that 10% tariffs cost Embraer $54 million in 2025 alone. It put a massive squeeze on their profit margins, particularly in their executive aviation and services divisions.
Because corporate buyers are highly sensitive to sudden price inflations, the Section 122 tariff was a formidable headwind, there's no doubt about it. But the critical metric for an investor isn't just the presence of the obstacle, it is the company's performance relative to it.
Right. They were succeeding despite it.
Yeah, they were essentially running a sprint with heavy weights strapped to them, and they still kept their footing. Embraer managed to sustain its market share in the U.S., which is overwhelmingly their largest market.
And they did that by actively integrating into the U.S. domestic supply chain, right? Positioning themselves not just as a foreign vendor, but as a stakeholder generating local American jobs.
Precisely. And then the regulatory environment shifted dramatically in their favor.
Huge pivot. Early 2026, we saw a massive legal shift. The Supreme Court issued a ruling that invalidated the tariffs previously established under IEPA, the International Emergency Economic Powers Act.
Which is basically a broad legislative tool used to restrict imports during national emergencies.
Right. So when the court pulled that tool back, a new executive order had to be drafted to establish the new trade rules. And within that new framework, aerospace products were granted a specific exemption known as Annex 2.
And that Annex 2 exemption is completely transformative for Embraer's unit economics. You can conceptualize it as a VIP pass through the new tariff barriers. Because of this specific carve-out, as of February 24, 2026, Embraer is operating under a zero tariff regime when importing into the U.S.
Which is huge. Removing a 10% blanket penalty literally overnight changes their entire pricing dynamic. They no longer have to artificially compress their margins to compete on price against rivals who didn't face those tariffs.
Rivals like Bombardier in Canada or Dassault in France, exactly.
So if they were already securing orders and performing well while eating a $54 million tariff burden, operating in a zero tariff environment unlocks a completely different tier of growth for them.
It absolutely does. And the financial data coming out of 2025 serves as the baseline for this. Embraer entered 2026 on a historic high. They just released their full-year figures and reported their strongest financial performance on record.
Right. They hit a total revenue of $7.58 billion for 2025.
Yeah.
That is a really robust 18% increase year over year.
It's substantial. But honestly, digging into the sources, the most compelling indicator of their future health isn't even the revenue. It is their backlog.
Oh, the backlog numbers are crazy.
In the fourth quarter of 2025, Embraer's firm order backlog hit an all-time record of $31.6 billion. That's a 20% jump from the previous year.
And for anyone listening who analyzes industrial manufacturing, the backlog is your window into the company's future revenue stability.
Exactly. A $31.6 billion backlog provides management with unprecedented visibility into their production schedules and cash flows for years. This surge is predominantly driven by a massive recovery in the commercial aviation sector.
Let's talk about the book-to-bill ratio, because that really quantifies the velocity of this demand.
Right. So for their commercial aviation division, which encompasses their E-175 and their newer E-2 jet platforms, the book-to-bill ratio reached 2.8x.
And if you are new to the book-to-bill ratio, it's a straightforward concept. A ratio of 1.0 means for every product a company ships, they get one new order to replace it. A 2.8x ratio means that for every single commercial aircraft Embraer finished delivered and got paid for, They secured almost 3 brand-new aircraft orders.
It is a clear mathematical indicator that global demand for their specific class of aircraft is radically outpacing their current fulfillment capabilities. It resulted in a 42% year-over-year expansion in their commercial aviation backlog alone.
And the execution side shows they are not just stacking paper orders, they are pushing metal out the door. They delivered a total of 244 aircraft in 2025.
That breaks down to 78 commercial passenger jets, 155 executive private jets, and 11 specialized defense aircraft.
Right, which is an 18% delivery increase from 2024.
Mm-hmm.
And Wall Street is obviously watching these execution metrics. But Embraer also just made a really strategic branding move to ensure the market understands the full scope of what they do.
The ticker change. Yeah, that rebranding initiative in late 2025 was a highly calculated signaling maneuver. Embraer officially petitioned to change its ticker symbol on the New York Stock Exchange. They transitioned from ERJ, which stood for Embraer Regional Jets, to simply EMBJ for Embraer Jets.
It might seem like just an administrative update, but changing a ticker symbol is a deliberate attempt to reshape institutional perception.
Oh, absolutely. They are actively telling asset managers and analysts to stop categorizing them strictly as a niche regional player. It is a demand for reclassification.
Because when you analyze their modern portfolio, the regional label just doesn't fit anymore.
Not at all. They operate a highly profitable executive aviation arm, a really disruptive defense and security division, a global services network, and they are heavily invested in advanced air mobility.
Right, the EVE program.
Yes, the EVE program developing the electric vertical takeoff and landing vehicles for urban air mobility. So the EMBJ ticker is a declaration that they are a diversified, comprehensive aerospace powerhouse, a viable third pillar challenging the legacy duopoly.
But to actually be a global powerhouse,
Yeah.
you have to expand geographically. You cannot just rely on North and South America. Looking at the strategic roadmap over the last 6 months, Embraer is executing an aggressive push into high-growth international markets, and India is the focal point right now.
The demographics and the economic trajectory of India make it an unavoidable market for any global transportation manufacturer. But penetrating the Indian defense and aerospace market is notoriously complex.
Because of the strict governmental regulations, right?
Exactly. So Embraer is utilizing a sophisticated dual-track approach. They are partnering with massive entrenched domestic conglomerates rather than trying to enter the market as an isolated foreign entity.
Let's break down the commercial track first. Embraer has signed an MOU, a Memorandum of Understanding, and is in advanced negotiations with the Adani Group, specifically their Adani Defense and Aerospace division.
And the objective there is huge. They are looking to establish a final assembly line, or a FAL, for the Embraer E-175 commercial jet directly within India.
The goal being to provide the infrastructure needed to vastly improve civil aviation connectivity between the smaller Tier 2 and Tier 3 Indian cities.
And strategically establishing a final assembly line on Indian soil is a masterstroke in regulatory navigation. The Indian government heavily incentivizes domestic production through its Make in India initiatives.
Right, while simultaneously placing heavy bureaucratic and financial burdens on fully assembled foreign imports.
Precisely. By partnering with a powerhouse like the Adani Group to localize the final assembly of the E-175 Embraer, elegantly bypasses those import complications. They instantly transform their profile from an external vendor extracting capital into a domestic manufacturing partner.
They are contributing to the local industrial base. And Embraer CEO indicated that if the requisite orders are formalized in 2026, they actually have the operational agility to begin rolling completed E-175 jets off an Indian assembly line by 2028.
Which is incredibly fast for aerospace manufacturing. But the second track of this India strategy is on the military sector, and that involves an alliance with a different industrial, Titan the Mahindra Group.
Right, this specific collaboration is laser-focused on pitching Embraer's C-390 Millennium medium transport aircraft to the Indian Air Force. And the scale of this defense contract is just staggering.
It really cannot be overstated. The Indian Air Force is currently preparing to issue a request for proposal for up to 60 new military transport aircraft to modernize their logistics capabilities.
60 aircraft. If the Embraer and Mahindra consortium secures this industry, estimates place the potential value at around $11 billion.
An $11 billion contract would fundamentally alter Embraer's financial trajectory. It provides a massive injection of stable long-term capital that is completely immune to the cycles of the commercial airline market.
But to win a contract of that magnitude against entrenched defense contractors, the hardware has to be undeniably superior. Which brings us to Embraer's defense and security segment. It is proving to be a highly disruptive force. In 2025 alone, their defense revenue surged by 36% year over year.
And as we just said, the defense segment offers a critical counterbalance to the volatility of commercial aviation. You are dealing with sovereign governments making decade-long procurement decisions. It creates a very stable revenue floor.
And the catalyst for that 36% revenue jump is the C390 Millennium. To understand why it's disrupting the market, you have to look at the historical context. For decades, the multi-mission tactical airlifter market has been a virtual monopoly controlled by the Lockheed Martin C-130 Hercules.
The C-130 is a legendary airframe, absolutely, but it relies on older turboprop technology. Embraer engineered the C-390 to directly attack that market share.
So the C-130 is practically synonymous with military transport. Convincing a defense ministry to abandon a proving legacy platform requires a major value proposition. What is the technological or economic edge that the C-390 actually offers?
It centers on modern architecture and operational efficiency. The C-390 utilizes modern jet engines rather than turboprops. This grants it true jet performance. It has a significantly higher top speed, which reduces transit times during critical missions.
It gets in and out faster.
Faster, and it carries more. It possesses a greater payload capacity, meaning it can carry more troops, heavy armor, or humanitarian supplies per flight, and it offers an extended operational range.
And crucially, they're delivering this enhanced performance envelope at a highly competitive price point, right? Both acquisition and life cycle costs.
Yes. For air forces attempting to modernize aging fleets under strict budgetary constraints, the value proposition of faster, heavier, and farther for less capital is incredibly persuasive.
And the global adoption rate strongly validates that. The C-390 is not just a domestic project for the Brazilian Air Force anymore. Embraer has steadily secured firm orders or formal adoptions from a growing list of NATO and allied nations.
Portugal, Hungary, Austria, the Netherlands, the Czech Republic, South Korea, they are systematically eroding the legacy monopoly.
But their defense strategy isn't limited just to heavy transport. They are also moving aggressively into next-generation software and AI integration.
Because adaptability to modern threat vectors is essential for any defense contractor's longevity today.
Right. In early March 2026, Embraer announced a highly strategic technology partnership with a firm called Valkyrie Aero. The primary objective of this collaboration is the integration of a new artificial intelligence suite designated the Gunslinger system directly into Embraer's existing A29 Super Tucano airframe.
Now, the A29 Super Tucano is a fascinating aircraft. It is a rugged, relatively low-cost turboprop designed for light attack, counterinsurgency, and pilot training.
So what does integrating an AI suite like Gunslinger actually accomplish for an older analog-style airframe like that?
It fundamentally repurposes the aircraft for the modern battlefield. The Gunslinger AI integration is specifically engineered to expand the A29's capabilities for CUAS missions.
Which stands for Counter Unmanned Aerial Systems.
Right, drone defense. The proliferation of cheap, weaponized drones has completely rewritten the tactical doctrines of modern warfare. Traditional air defense systems, which use million-dollar missiles to shoot down threats, are economically unviable against swarms of inexpensive drones.
The math just doesn't work. You can't fire a $2 million Patriot missile at a $500 commercial drone.
Exactly. So by upgrading the proven highly cost-effective A29 airframe with advanced AI targeting and tracking systems, Embraer is offering militaries an economically sustainable solution to neutralize one of the most asymmetric security challenges out there.
It is a textbook example of extending the life cycle of a legacy product through smart technological integration. And speaking of calculated strategic pivots, Embraer is also executing a highly deliberate expansion into the United States defense market.
Yes, their partnership with Northrop Grumman.
Exactly. They recently formalized a partnership with the American aerospace giant Northrop Grumman to develop aerial refueling boom capabilities for the C-390.
And you have to remember, the United States Air Force operates the largest aerial refueling tanker fleet on the planet, and they are constantly evaluating options to modernize and recapitalize that fleet.
By developing boom refueling capabilities, which is the specific standard required by most U.S. combat aircraft. Embraer and Northrop Grumman are positioning the C-390 as a highly capable right-sized option to complement the massive U.S. tanker ecosystem.
But what really stands out in the research regarding this U.S. strategy is the manufacturing promise tied to it.
Right. Embraer's executive management explicitly committed that if they are successful in securing a sizable order from the United States military, the final assembly of those specific C-390s will be conducted entirely within the United States.
Again, we see this recurring theme, right? securing international contracts by committing to localizing the manufacturing footprint, aligning their corporate interests directly with the national security and job creation priorities of the buyer.
It is a sophisticated geopolitical strategy that completely neutralizes the foreign contractor stigma. But while the defense segment provides crucial stability and prestige, the financial engine of Embraer is still heavily reliant on the civilian side.
Definitely. Let's transition to the aircraft that corporate executives and everyday passengers interact with. The executive and commercial aviation segments are performing exceptionally well.
In the Executive Aviation division, Embraer delivered 155 private jets in 2025.
The executive jet market is demonstrating remarkable resilience. Much of this sustained volume is being driven by institutional buyers, specifically fractional ownership providers.
Companies like NetJets,
Yeah,
right?
exactly, NetJets. They purchase fleets of aircraft and sell shares of flight time to high net worth individuals and corporations. They are massive demand drivers. And within Embraer's portfolio, the absolute standout performer continues to be the Phenom 300 series.
The consistency of the Phenom 300 is genuinely staggering. According to the industry data, it has retained its title as the world's best-selling light jet for 14 consecutive years.
14 years. Maintaining market dominance for nearly a decade and a half in a highly competitive, luxury-focused sector is a testament to the initial engineering.
They are actively working to protect their market share in the larger categories, too. In early 2026, Embraer refreshed their executive lineup with the introduction of the new Praetor 500E and Praetor 600E variants.
The introduction of the E variants, which typically denote enhancements in avionics, interior comfort, and operational efficiency, is a direct aggressive challenge to their primary competitors in the super midsize category, namely Bombardier and Gulfstream.
Embraer is ensuring their portfolio offers the cutting-edge amenities that corporate flight departments demand. However, from an investment perspective, the most compelling update regarding the Praetor line isn't a new cabin feature. It is an operational milestone.
Right. Embraer announced they have successfully slashed the overall manufacturing time for the Praetor jets by an incredible 40%.
When you can reduce the time it takes to build a multi-million-dollar asset by 40% while simultaneously experiencing surging market demand, the impact on your operational leverage and profit margins is exponential.
You are pushing inventory out the door faster and realizing revenue quicker. It's huge.
And this focus on operational efficiency is mirrored in their commercial aviation segment. For anyone flying regional routes within the United States, Embraer's footprint is massive. Current data shows that over 40% of flights operating out of key U.S. regional airports utilize Embraer aircraft.
They are responsible for transporting approximately 100 million passengers annually in the U.S. domestic market alone. That level of market penetration makes them an indispensable pillar of U.S. domestic infrastructure.
And we are currently observing a critical generational transition within that commercial fleet. Embraer is actively migrating operators from their older E1 platform to the next generation E2 platform.
The E2 family features advanced aerodynamics, updated fly-by-wire systems, and entirely new engine options that offer dramatic improvements in fuel efficiency and noise reduction.
And the delivery data confirms this transition is accelerating. The newer E2 platform is now officially outpacing the legacy E1 in terms of physical deliveries. In 2025, Embraer delivered 44 of the E2 variants compared to 34 of the older E1s.
Looking at the horizon, management is not projecting a plateau here. They have publicly established a highly ambitious long-term operational goal. They intend to aggressively ramp up their commercial production capacity until they are consistently delivering 100 E-jets annually by the year 2027.
Achieving 100 commercial deliveries annually would represent a massive scale-up from their current output. It would deeply solidify their position against any attempts by Airbus with their A220 program to encroach on the regional market.
So when you synthesize all these data points, the record-breaking revenue, the historic $31.6 billion backlog disruptive advancements in defense with the C-390, the elimination of that 10% U.S. import tariff, and the massive 40% efficiency gains, it forms an incredibly potent bull case.
It does. However, as an investor analyzing risk, you have to remain objective and seek out the vulnerabilities. What are the operational hurdles that could derail this momentum? Because the research makes it very clear that significant systemic risks remain in play.
Objective analysis requires us to heavily scrutinize the fragility inherent in the system. While Embraer has navigated recent crises better than the legacy duopoly, they are not immune to the broader macroeconomic environment.
The global aerospace supply chain continues to suffer from what industry analysts categorize as structural fragility. And the single most acute headwind currently threatening Embraer and the wider aviation industry centers on engine reliability and consistent supply.
We need to examine the specific issues surrounding Pratt and Whitney and their geared turbofan or GTF engines. This has been a major disruptive force across the commercial aviation sector.
Right, the GTF engine platform has experienced highly publicized and severe durability issues that have impacted airlines globally.
The fundamental root cause was identified as a rare metallurgical anomaly, specifically powdered metal defects that occurred during the manufacturing process of certain high-pressure engine components.
And because these components are subjected to extreme stress and temperatures, any structural defect poses a critical safety risk. Consequently, the Federal Aviation Administration mandated accelerated, highly rigorous early inspections for a vast portion of the active GTF fleet.
And an FAA-mandated inspection on a commercial jet engine is not a trivial procedure. The sources outline that these required inspections and the subsequent grounding of aircraft are creating massive logistical nightmares for commercial operators.
To highlight the severity, one major U.S. airline explicitly noted in their annual financial report that they estimate each removed engine will require approximately 360 days to complete a full shop visit and be returned to a serviceable condition.
Almost a full year. Having a primary revenue-generating asset grounded for a full calendar year creates immense friction between manufacturers and airlines. It is a devastating bottleneck for airline capacity.
Now, it is crucial to properly contextualize Embraer's specific exposure to this crisis, right?
Yes, because Embraer utilizes a distinct variant of the GTF family, the PW1900G, specifically for their E2 family of commercial jets.
Embraer's management has publicly stated that their specific PW1900G engine variants have historically performed more reliably and fared better regarding these inspection mandates than the larger GTF variants utilized on the narrow-body aircraft produced by their competitors.
Right. During their recent earnings calls, Embraer's CEO projected confidence, stating they do not foresee any big issues with Pratt & Whitney's ability to support Embraer's specific delivery targets for 2026.
However, as an analyst, you cannot entirely discount the macro risk. Even if their specific variant is performing better, any widespread systemic grounding part shortage or maintenance backlog within the broader Pratt & Whitney ecosystem remains a serious margin and schedule risk.
Because if engines don't arrive on the factory floor, completed airframes cannot be delivered and revenue cannot be recognized. It's that simple.
And beyond the propulsion systems, investors continually raise concerns regarding access to critical raw materials. Titanium and aluminum are the lifeblood of aerospace manufacturing. Given the geopolitical disruptions we discussed earlier, are they facing imminent shortages that could halt production?
Surprisingly, the direct answer for management is no. They address the raw material concern directly in their briefings, stating that their strategic stockpiling efforts have actually been successful.
They are currently quite comfortable with their inventory reserves of raw aluminum and titanium to support their 2026 production goals.
The true structural bottleneck is not the availability of raw, unrefined metal. The bottleneck exists downstream. It is the availability of highly specialized machine parts and the skilled labor required to assemble them,
which introduces significant execution risk regarding their production ramp-up. Embraer is attempting to substantially increase their total deliveries across all segments. This requires flawless logistical execution across their entire global manufacturing footprint.
Any localized labor disputes, shortages of specialized aerospace technicians, or localized logistical bottlenecks at their primary production facilities, whether in Melbourne, Florida, or São José dos Campos in Brazil, could cascade through the schedule.
And that would force management to revise their financial estimates downward. So if the risks of specialized parts shortages and labor bottlenecks are so acute, how is management actively mitigating them?
This brings us full circle to the resilience-first strategy. Embraer is aggressively shedding the outdated just-in-time philosophy. To combat the structural fragility of the supply chain, they are initiating deep process digitalization across their manufacturing base.
The technological integration is comprehensive. They are investing heavily in customized artificial intelligence tools designed specifically for production leveling.
And in practice, this means they are utilizing predictive AI models to analyze complex supply chain data, smooth out the manufacturing flow, and proactively anticipate potential bottlenecks weeks or months before they actually manifest on the assembly floor.
So instead of reacting to a missing part, the AI flags the probability of a shortage, allowing procurement teams to intervene early.
Furthermore, they are fundamentally altering their supplier relationships. moving away from purely transactional interactions toward collaborative, proactive partnerships to ensure long-term stability.
Geopolitics also present external risks that require monitoring. Management was specifically questioned regarding the escalating tensions in the Middle East, particularly the ongoing war in Iran and how that might affect global shipping and sales.
They noted they are monitoring the situation with extreme vigilance. Their stated primary focus is ensuring the safety of their personnel stationed in the region, followed closely by protecting their direct and indirect supply lines from disruption.
But crucially, as of their latest financial reporting period, they have not recorded any critical impacts to delivery schedules or short-term sales resulting directly from that specific conflict.
All of these sophisticated mitigation protocols, the AI-driven production, leveling the stockpiling of raw materials, the transition to collaborative supplier networks, the resilience-first supply chain architecture, they all serve a singular purpose.
Ensuring that a historic $31.6 billion paper backlog actually translates into physical aircraft delivered on schedule.
Because ultimately, a massive backlog only generates value for shareholders if the manufacturer possesses the operational capacity to build the planes.
Which naturally leads us to evaluate their official outlook for the future. Based on all these factors, Embraer management has issued what financial analysts are categorizing as cautiously aggressive guidance for the 2026 fiscal year. Let's examine the specific numbers they are projecting to the market.
For 2026, they are forecasting consolidated total revenues to land between $8.2 billion and $8.5 billion.
Translating those revenue targets into physical hardware, their 2026 guidance projects delivering between 80 and 85 commercial passenger jets, alongside 160 to 170 executive jets.
If they successfully execute at the high end of those provided ranges, we are looking at a combined delivery potential of up to 255 aircraft for the year. This represents a highly aggressive acceleration in their manufacturing tempo.
They are also providing clear visibility into their profitability targets. Management is targeting an adjusted EBIT margin between 8.7% and 9.3%.
For those newer to financial modeling, adjusted EBIT stands for earnings before interest and taxes. Essentially, it means that for every dollar of revenue Embraer generates, they expect to retain roughly 9 cents of pure operational profit before accounting for their debt obligations or tax liabilities.
Additionally, they project their free cash flow, which is the actual tangible cash left over after paying for all operating expenses and capital expenditures, to be $200 million or higher.
But the most critical nuance to understand regarding that specific margin guidance is the timing of its release. Management formulated and released that 8.7 to 9.3% adjusted EBIT target before the Supreme Court ruling officially invalidated the IEEPA tariffs.
Right. So the sudden removal of that 10% U.S. import penalty, layered on top of the 40% manufacturing efficiency gains in their executive jet lines, and the launch of higher margin products like the Praetor E variants, it fundamentally alters their cost structure.
It absolutely does. It sets the stage for potentially significant margin expansion throughout 2026 that may not be fully priced into their initial guidance. They appear perfectly positioned to capitalize on this shifting economic momentum.
It truly is a remarkable convergence of macroeconomic and operational factors.
Yeah.
You are looking at a manufacturer that survived a highly disruptive, terminated merger agreement with Boeing just a few years ago. They then successfully navigated intense margin-crushing tariff headwinds.
And now they find themselves sitting on an all-time record backlog, operating in a newly established zero-tariff environment in their most critical market, all while their massive legacy competitors are severely entangled in retaliatory trade wars, 125% tariffs, and fundamental supply chain breakdowns.
The contrast is stark, and it forces a broader evaluation of the industry's future architecture. As you synthesize the data from this deep dive, consider this final thought.
We are currently watching the historical duopoly of legacy Western aerospace manufacturers struggle to navigate an unprecedented simultaneous convergence of crises, from restrictive geopolitical tariffs blocking deliveries to the foundational breakdown of the just-in-time supply chain model.
As these entrenched giants continue to stumble and redirect their capital inward to fix structural issues, is the global aviation industry quietly witnessing the permanent, irreversible rise of a new, highly agile third pillar emerging from the global south.
It is the defining question for aerospace investors this year.
We hope you enjoyed this deep dive, and thanks for listening. Please follow us and subscribe on your favorite platforms. Don't forget to check out our Substack, Delta Investments. Until next time, this analysis is based on publicly available information and does not constitute financial advice. Always conduct your own research before making investment decisions. By listening to this podcast, you agree that you are in charge of your own decisions and risks, and that you are solely responsible for any investment decisions you make.